If you're serious about saving for your retirement, as well as picking the right investments, you need to understand the impact charges can have on your money. If you're investing in funds, even a small increase in annual charges can seriously add up over the years you're saving. This is because the main annual charge you pay is set as a percentage of the money you've invested. As your money grows, the amount you pay increases. This can significantly reduce the size of your pension pot. Let's take the example of someone who's already well advanced on the savings front. This person has £100,000 in various savings accounts and has decided to move it all into a self-invested personal pension, or SIPP. They've still got 25 years to go to retirement, plenty of time for their money to grow further. For this illustration, I'm assuming their money grows at a steady 6% a year. Of course, that's completely unrealistic. Stock markets and share prices swing up and down. You'd never get a constant 6% unless you were in a high-interest savings account. And there are no savings accounts paying anywhere near 6% today. And even when there were some, they didn't do it for 25 years. Let's make this even more unrealistic and pretend there are no charges to pay for the fund managers this investor hopes will grow the money faster than when it was in a savings account. With no costs and an annual rate of 6%, the money grows to nearly £446,000 over 25 years. This would be a really decent pension pot to retire on. In real life, there are investment charges. Let's look at what happens with annual charges of 0.5%, 1% and 2%. At 0.5%, this investor pays £65,000 in total charges over 25 years. Double that annual charge to 1% and our investor pays nearly £108,000. That's more going in charges than the amount originally invested. At 2%, total costs increase to nearly £180,000. As charges rise, investment returns fall. At 0.5%, the investor makes a gain of £281,000 over 25 years, falling to £238,000 at 1% and £166,500 at 2%. In percentage terms, the 0.5% charge leaves the individual with the best investment return of 281%, falling to 239% with the 1% charge and 166% at 2%. Higher charges inevitably mean a smaller pension pot. With a 0.5% charge, the investor's £100,000 grows to £381,000. At 1%, the investor ends up with nearly £339,000 or £42,000 less. At 2%, the pension pot falls another £72,000 to £266,500. This is still a lot more than many people retire on, but it's £114,000 less than when the charges were at 0.5%. Higher charges can be okay if you're getting a higher return, or if you're getting advice or investment management that's worth paying for. The 0.5% charge is roughly what you might pay if you were investing by yourself in a low-cost fund tracking a stock market index like the FTSE All-Share. At this level, you might not mind a 6% annual return, as even after charges, you're left with a reasonable return. However, more expensive, actively managed funds need to generate higher returns to leave you in the same position. When investing in these funds, you need to be confident the fund manager can pick stocks and shares that will significantly beat the index over a 5-year period. A 1% annual charge is roughly what you might pay for an investment trust or a unit trust investing in bonds. Traditionally, unit trusts investing in shares have charged 1.5% a year. On 6% growth, that would leave them between the two bottom lines on our chart. However, the abolition of commission paid to advisors and fund distributors is beginning to change this. In the past, this commission was baked into the annual charge. But with commission gone, clean annual management charges of 0.75% are becoming increasingly available if you buy your funds from an online fund supermarket or platform. It's good news, but don't necessarily expect your costs to halve overnight, as the platforms are starting to charge fees to make up for the loss of commission. At 2%, you're round about the level of hedge funds or fund of funds investing in other funds. Here you really need to be sure you're getting the extra return to justify the cost. The other way you might encounter all-in costs at this level is if you use an independent financial advisor or wealth manager. Their fee plus fund charges can easily add up to 2% a year. This is a lot of money, but in return you should be getting a comprehensive financial and investment plan and someone to keep your retirement plans on track. Many advisors offer tiered charges which fall in percentage terms as the amount of money their clients have with them increases. It's quite possible we'll see more tiered charges for DIY investors in future. Having looked at these figures, you can see why. Charges add up and can have a significant impact on your wealth.